All right, so today I want to talk about a stock I've never talked about. This is one that I've been dollar cost averaging for about 6 months, maybe a little longer. APH is the symbol, Amphenol. Again, so they are an electrical equipment manufacturer, $52 billion company out of Connecticut. Engages in the design, manufacture, and marketing of electrical, electronic, and fiber optic connectors, intercontinent systems, antennas, sensors, and sensor-based products, and specialty cable. Company is headquartered in Connecticut and employs 91,000 employees. So again, a pretty big company. This is a company that, again, just under a 1% dividend, 3.68% earnings yield. Let's get into the insights here, dig a little bit deeper. The dividend I'll get into after. Financial health is solid. The intangibles are a little high, but current ratio 2.33, that's very good. The growth is solid as well. Not crazy good, but I think it's still solid. Profitability, again, good, not crazy good. Management, definitely very, very good there. And then the valuation, again, very, very important. You always check on the valuation of any company you're looking into. PE, 27.75, 5-year average 27.24. Price to free cash flow, 27.2, 5-year average 29.7. So this company probably is about fair value where it's at right now. Although if you look at price to free cash flow, it's probably actually a tiny bit below that. It's basically at its 52-week high. 52-week high is 90.28, and it's right around 88 and change. So again, ideally you would pick it up a little bit cheaper, but again, it looks like it's right about fair value where it's at right now. Let's just check the historical valuation. So again, if we look at the price to free cash flow, excluding stock-based compensation, we can do that as well. The average over the last 10 years is 28.7, and the latest is 28.58, right? So it's basically right on that average, right? Which leads me to say why it's basically fair value where it's at. I mean, if we go back, I mean, it got very, very high in the big bull run late 2021. It got up to about 48. So it definitely was expensive there. But I mean, aside from, March of 2020, it got down to about 18.6. In 2016, it got down to 17.2. Basically, it never goes below 20 other than that, right? I mean, it got down to 24 in May of this year. So again, if it appears that if you can get it below 25 or so, it looks like that's a bargain, right? Below 25, roughly. Again, it went down there in 2020 as well. But again, even below 30, like you're looking at about fair value, right? It's only gone above 30, 3 times roughly over the last 10 years. It was above there for basically all of 2021, and even a lot of 2022. So again, that is the valuation on it. Let's get into it a little bit deeper. Let's check out the financials while we're at it, because again, that's also very important. If we look at the financials here, let's start off with the metrics. Again, operating margin literally is almost always around 20%, which is good, right? It's not great, but 20% is very good. It is a solid operating margin. The lowest it's gone in the last 8 years is 19.19, and the highest is 20.67. So again, that's very consistent profitable company. And again, that is why I really, really like this company, because they're so consistent, right? They're not the most profitable company you'll see, but they're so consistent. I mean, look at that operating margin, how consistent that is, right? I mean, just consistent as can be, right? So again, that's what I just really like about this company, is they're just very consistent there, right? Cash flow, let's check out the cash flow here. Again, another very important metric you're going to want to look at. Again, free cash flow is growing very nicely over time. I mean, you go back 10 years, they had 610. Now they're up to 1.8, right? So they've roughly tripled that free cash flow over 10 years, which again is solid growth. It's not great, but it's very solid. They have been issuing debt, quite a bit of debt, or not a ton, but a decent amount of debt. 2022, it looks like they started paying it down for the first time basically ever. So that's a good sign. I hope they continue that trend. They haven't issued a new share in a very long time, which is good to see, right? You always want to see companies that are that are buying back shares, right? If we look at the balance sheet here, definitely do not have a very concerning amount of debt, right? I mean, 55% of their debt is long term, which is good, I think. And again, they do have clearly more assets and liabilities, which is also good to see. The last thing I wanted to bring up here, again, the dividend. This is another thing I really like about this company. Again, it is just below 1%, 0.95%. The payout ratio is only about 26%, which is very good. They're growing at 12.8% per year, which is very good, right? That's almost exactly what I would be doing. Again, you go back 10 years, you got about a 4.5% yield on cost. Let's go back 20 years, right? Just for curiosity here, you got about a 25% yield on cost, right? A 25% yield on cost. That means you're getting a 25% return on that initial investment every single year, regardless of what the share does. I mean, if it goes down, technically it's less. If it goes up, it's more. But you know what I mean, right? So again, that's why I really like companies like this. Again, consistent profits, nice dividend growth. Again, I don't care what the dividend is right now. I want that high dividend 10, 20 years down the road, right? Which is exactly what you're going to get from a company like this, I believe. So anyway, that's what I wanted to bring up today. If you liked the video, hit that like and subscribe and stay tuned for more.